Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 224 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvily, bring you into our world of financial markets and financial planning. Back by popular demand, our Director of Research and Trading, Nick Whitaker, filling in for Matt as he is busy with work items all day. So Nick, thanks for coming back on this morning.
Always good to be here.
Been quite the couple of months, but just the past 2 weeks for the markets. A lot going on geopolitically, a lot going on with the economy, a lot going on with the stock market. We're in the middle of earnings season. Volatility is picking up, so there are several things to discuss, and I'm sure that we're going to continue to discuss over the next couple of weeks. But as always, we will quickly review the month-to-date and year-to-date performance for the major market indices that we track. This data is from YCharts, and as of October 25th on the market close, S&P 500 index up 9% for the year. The Dow Jones Industrial Average down 0.3% for the year. S&P 500 down 2.4% for the month. Dow Jones Industrial Average down 1.5% for the month. The NASDAQ Composite Index down 3% for the month, still up 22% for the year. The Russell 2000 Small Cap Index down 7.5% for the month and down 6.1% per year. And the Vanguard All World X United States ETF down 3.6% for month and down 0.3% for the year. 3-month Treasury rate at 5.59%, the 2-year Treasury rate at 5.08%, and the 10-year Treasury rate at 4.95%. Moving on to big headlines, current events from the week, Nick. This just came out this morning that I think was pretty surprising for most people, that the U.S. economy actually grew GDP by 4.9% in the third quarter. This was heavily driven by consumer spending, which makes up the largest part of the U.S. economy. And this came in much stronger than analysts had anticipated. So it'll be interesting to see how the market kind of digests this information with all the volatility going on. But it again aids to what we've been kind of talking about all year, is that the consumer still remains strong. And if we're going to have a recession in this country, we're going to need to see signs of the consumer weakening, and we're just not seeing that right now.
Yeah, I mean, I'm actually going to talk a little bit about the strength of the consumer and why the consumer's been so strong a little bit later in the podcast. But the beat, just, I don't know, I might have missed this, but consensus was 4.3 on that U.S. GDP numbers of 4.9 is a pretty big beat.
Yeah, absolutely. So, and then like we kind of just talked about, Nick, market volatility has picked up. During earnings season, there's a lot going on in the world. We have, tensions continuing to rise in the Middle East, which could threaten the deflationary environment or disinflation that we've been experiencing over the past year or so. I don't think it's any surprise to anybody that energy makes up most of the inflation calculation. So, if that conflict goes on, longer than people anticipate, that could drive inflation back up, which would be followed most likely by increased interest rates by the Federal Reserve when they are planning to be done for right now, which could spook markets and would not be a great thing for risk assets. I think that's probably the worst case scenario. Obviously, best case scenario, things come to a peaceful resolution. Inflation continues to come down. Earnings from now until the end of the quarter come in strong, and we get a Santa Claus rally into the end of the year. But as always, that will have to wait, and we'll have to see how the market plays out the rest of the year.
Yeah, very, very well said. One thing I want to point out, and we can talk just quickly about it for listeners. because it's just kind of occurring to me that in the past, when we've talked about wars and other international geopolitical skirmishes, a lot of times we talk about how it's not going to impact the market. The market's going to kind of move right past it. And this time it's a little different. And I think maybe just given investors and listeners just a quick overview as to why it's different. A lot of the reasons it's different is because of the rate environment we're in, because we're fighting inflation so much, and because obviously where the war is located has direct ties to the energy markets and OPEC, and um, can have like you were mentioning a very drastic effect on inflation. And when the whole world, for the most part, that's a big generalization, but a lot of the world, their central banking policy is already very high. They're already dealing with high inflation, or trying to combat inflation and getting it down. And so that's why this war is a little different than moments we've seen in the past. I don't know if you have anything to add to that, but
No, I think it actually kind of plays kind of right into the first thing that I had. And, the first thing I have, Nick, is a tweet from the Money Visuals account, excuse me, which is run by our friend Ashby Daniels. He's been on the show before very early on. So he does a really good job with this account. It's a great follow if people want to follow it on Twitter and Instagram. It's at MV Money Visuals. So he says, if you think the future is going to look any different than the past, you're probably wrong. This is true for both the continuation of progress itself as well as the chaos that comes along for the ride. As much as you might dislike it, they are inseparable. And it's this chart that says the story of human progress. And, the chart is going from the bottom left to the upper right hand corner of the screen. And every zig and every zag, there's chaos at every turn, right? And I thought that this was really good because there's always going to be something crazy going on in the world. There's never going to be a time where things are perfect, everything is hunky dory, and it's just not how the world works, right? And I think this
it's
goes
not how humans work.
right. It goes for investing and just life in general. And I think it's a good reminder to focus on, what you can control. And, I think we talked about this a little bit a few years back when we had JC Peretz on the podcast. I think I made the comment or alluded to, crazy times we're living in. I think this was closer to COVID. And he kind of just took it in stride and was like, yeah, but Mark, isn't every time kind of a crazy time? Because there's always something that could, spook markets. There's always something that could push markets lower. And that's just part of investing. And again, not just in investing, but in life in general, life's going to throw you curveballs, and you're going to have to figure out a way to deal with the twists and turns that life gives you. And it's no different from the market. It's just having a plan, agreeing on your plan, sticking to it in good times and bad can really help smooth out those chaotic periods. So I just thought that this was a really good visual, no pun intended, for listeners to kind of take a peek at.
Yeah, yeah, very, very well said. I completely agree. You can track history every which way. An advanced progress and in any form is going to follow by chaotic, sometimes terrible things. So
Right, right. And a good example of this is actually just because I got done watching it not that long ago. I watched Super Pumped on Netflix. It's about the rise and kind of fall a little bit of Uber, and in particular the one of the founders, Travis Kalanick.
mhm.
And oh my gosh, if you want to talk about chaos, that was kind of a wild story, and they had so many twists and turns that they had to deal with. And look at what Uber is today. It's a major, major part
Mhm.
of our everyday life.
Yeah, fundamental, I would say.
It is
Fundamental.
fundamental, and it's
Yeah,
and it's changed the world, I think, for the better, whether you're, Uber or Lyft, just ride sharing in general.
yeah.
And but I guess my point is it took a lot of chaos to get there, right? They were fighting with, state and local governments because of the taxi unions and, medallions in New York
Oh
City and
yeah,
in California and all that stuff. And, you know,
yeah. I
um
remember that. I remember
it,
a lot
It
of that in
sounds
the
like
news.
from the movie that, Travis had some, interesting ways to go about things and interesting company culture that was, it just seemed like it was chaos 24/7. But now it's such a huge part of, the American way of life. And, from taking it from Uber to where we're going to go next, I know this is still really early, but in Dayton, just a couple months ago or a month or two ago,
Mhm.
Joby Aviation announced that they're going to have their hub here to start like flying cars, right? So,
Mhm. Yeah,
instead
like they,
of Ubering in a car, you're probably going to be able to Uber or order one of these, flying apps on your phone, and they'll come pick you up
yeah.
and take you to Cincinnati or Columbus and, have you there in 10, 15 minutes. So this stuff's going to continue to evolve, but it's not going to be without chaos. So I think there's a lot of lessons that we can take away from
Yeah.
that.
Always bumps along the road.
Second thing I had, Nick, interesting to get your take on this. This was a chart from Bloomberg and the Grindstone Intelligence blog. It shows annualized earnings and revenue growth forecasted for 2024 to 2025, and it lists it by sector. And this was really interesting to me because earnings growth, at least to me, still looks pretty strong over the next couple of years. The forecasted earnings growth of publicly traded companies, and in particular in the tech sector, right? So at the top of this
Mm.
graph, you have information technology. Forecasted growth looks to be anywhere between 17 and 18% from 2024 to 2025. So I thought that this was interesting given the market volatility that we're experiencing right now. But to a certain extent, this kind of makes sense to me, right, Nick? I think it's really important to remind, people that aren't in the industry every single day that the market is very forward looking and it prices things in way in advance.
Mm.
And I think this is a really good example of this because, the forecast, the only sector in the S&P 500 with forecasted negative revenue growth and negative earnings growth is energy. And through the first half of 2023, energy was one of the worst sectors. It was negative. It was only the past couple of months when energy started to pick back up again. And I think that's a really good example of, the market saying, hey, earnings growth is going to be pretty lackluster or not existent in 2024, 2025. So energy isn't performing that well in 2023. And I think the opposite side of the coin, obviously tech has been the best industry or excuse me, sector this year. And it has the highest forecasted revenue and earnings growth between 2024 and 2025. So, the market's not necessarily focused on what exactly is going on right now, and especially not what has happened in the past, but more so over the next several years. And I think this is a really good example of this. Now, does this mean that the market's going to continue to go up through the end of this year and next year and in 2025? Absolutely not. Anything can
Mhm.
happen. But just given where we are today, I thought that that was kind of a good example of how forward-looking markets truly are. Is there anything you want to add to that?
Yeah, two things kind of jump out to me. One, um, is the continued strength of earnings relative to revenue in the information technology sector. And I'm guessing if we kind of broke that out, a lot of that would be dominated by some of the bigger names, some of the bigger
Yeah,
players that just
yeah,
make a lot of money, and contribute to earnings. I would guess that when you kind of start going further down the market cap, um, list within tech, you'll start to see that revenue kind of go up, but the earnings come down because a lot of your smaller tech names, they're not generating as much profits yet, right? They're the future, so there's a lot of revenue growth, but they're still, working through their ops. So that's definitely a piece of technology. So that kind of surprised me just a little bit when you think about how big Amazon, Apple, Microsoft, Google, et cetera, how big they are, and that is not an advertisement to buy or sell any of those names. But when you think about how big those names are, that's probably why, that's the case. And the other thing that just jumped out at me a little bit was financials and just how low both the revenue and the earnings earnings growth is in that space. I mean, lower than materials, consumer staples, utilities. I mean, that surprises me a little bit, especially in the rate environment that we're in, and with the Fed saying that they're going to hold higher for longer. But that really has been the story, for a number of years now. Arguably decades.
Yeah,
Post
yeah,
Great
it's
Financial Crisis, this has been the story for the energy, or excuse me, for the financial space, and um, yeah, it just surprises me a little bit. We think about Wall Street, we think about banking, and the bulge bracket banks that are the hub of the entire system, and it surprises me a little bit to see such low rates down there.
yeah, yeah, for sure. So, and again, I think this is another way to look at, how inflation impacts, publicly traded companies, Nick, is that, when you have inflation running at, 4 or 5%, it devalues these companies' earnings and revenue growth, right? Because on
Yeah,
real
big time.
numbers, for example, if inflation's at 5%, then financials, really isn't growing at all, right? In
Yeah, yeah,
terms
yeah.
of earnings and revenues. So that's one of the ways that, inflation, and higher interest rates kind of impact publicly traded companies. So
It's a good
anyways,
point. Yeah.
last thing I have, Nick, is just a simple quote from Ron Chernow. Um, and he says, quote, stock market corrections, although painful at the time, are actually a very healthy part of the whole mechanism because there are always speculative excesses that develop, particularly during the long bull market. So just thought that this was pretty timely with everything that's going on. Um, you know, Still, as of right now, this is still a somewhat seasonally weak period. But if it goes on for too much longer, then that would start to buck the seasonal trends that we've seen over the past couple of decades in the fall. So again, I don't think it's time to hit the panic button just yet, because as quick as this market has kind of dropped the past couple of weeks, it could be, a quick rebound to the upside. So I don't think this is the time to make any drastic changes to portfolios or strategy yet. Now that could change very quickly, as we've
hmm
seen in the past, but um, just wanted to throw that out there because I think it is very timely.
Yeah, it's a great quote, and just jumping on the back of what you said, we're still in the heat of earnings season. So, like you said, this could swing day over day. You're going to have increased volatility, and the narrative could really change in a week or two, with some more of the big names coming to report soon. So. The first piece of research I have here is just a detailed look at year-to-date performance across the S&P. This is research from Charlie Balelo, on the 20th of October. So it's a little stale, but still a great chart. Charlie says the following: it's been a great year for the 50 largest stocks in the S&P 500, which are still up 24% year to date. I'm guessing that's come down a little bit since this note, which are still up 24% year to date, even after the recent pullback. But the performance of the average stock paints a very different picture for the S&P 500 equal weight, down 1% year to date, and small caps down 3.5% year to date. And we'll throw this chart up here, and you can see just how drastic the percent gain falls as you get further down the market cap scale. So, your top 50 being 24, top 100 18, um, just the standard benchmark equal standard weight, 12, and then an equal weight, i.e., if you took 1% and just equal it, completely equal across every name in the S&P 500, actually down, while the top 50 are up 24%. So we've talked about this a little bit in the past with how weak small caps have been, but it's pretty noticeable, the breadth in the market, this year and over the past few months. So I don't
Yeah,
know
and
if you have anything to add there.
just for new listeners, when Nick talks about breadth, he's not talking about like like breath coming out of your mouth. He's talking about market breadth, which is a indicator of how many stocks are rising or falling, or how many stocks are in uptrends versus downtrends. And typically, in most market environments, we want to see a large amount of stocks participating to the upside, carrying the market higher. That would be characterized as having strong breadth in the market. But this year, breadth has been extremely weak. It's, like you can see on this chart, the S&P 50, the largest 50 names in the S&P 500 have done really well, and some of the medium and smaller cap names have done very poorly. And I
Yeah.
would even go to venture, if there was an ETF that tracked the top 10 stocks in the
Yeah.
S&P 500,
Yeah.
this would just be more magnified. And I think,
Yep.
why we're seeing significant market weakness right now is because, some of those big guns, Apple, Amazon, Nvidia, Tesla, they're starting to show a little bit of weakness on the short term basis. So if you have the mega cat names being weak along with the rest of the market, then I don't think you have to be a genius to say that's
Yeah.
not a very successful recipe for returns going forward. But really interesting chart here. It's been an interesting year. I mean, like we said, the safety trade has been, these large cap names, these mega cap names for a long period of time. But if those start to go down along with the rest of the market, then, that's an issue.
Mm, absolutely. The next piece I have is economists increasing their U.S. growth projections. Pretty timely with U.S. GDP coming out and beating today. This is from Bloomberg, also on the 20th. Says the following, and this is just a snippet from the article. Economists raised their U.S. growth projections through early 2024 and trimmed recession odds to a one-year low as consumers continue to spend, which you mentioned earlier. The Bloomberg survey was conducted between October 13th and 18th and included responses from 74 economists. Here's a quote within the article. Despite current economic readings coming in stronger, we still expect a mild recession to unfold in 2024, said Kathy Bostanek. Uh, Sorry about that, Kathy, chief economist at Nationwide Life Insurance. The jump in yields that underpin borrower rates will engineer a slowing employment, and income growth will lead to a pullback in consumer spending. We'll throw up this chart here, and the chart says Wall Street grows increasingly optimistic on the outlook, and you can see the difference between the September survey and the October survey. Q3 coming up 0.5%, Q4 coming up a bit, Q1 coming up a bit. And then it's about pretty much the same from there on out. Um, but it just goes back to what you said at the beginning of the show, that the consumer stays strong, and things are still holding on from an economic point of view, and economists have had to adjust again.
Yeah, I really don't have anything to add. I think it's no secret that I'm not a huge fan of surveys and things of that
Mhm.
nature. But I think it just goes to show you how quickly, estimates and forecasts can change based on what's going on in the world.
Oh yeah, absolutely. And my last piece here is another survey, Federal Reserve survey. It's on median net worth during the pandemic. This is an article was featured in Wall Street Journal, Bloomberg, National Public Radio, New York Times, back on the 18th. It's a pretty good article. I encourage people to read it. One of the things I like about it is I think it explains why the general reason for why the economy has been so resilient, or at least kind of gives us ideas to really hone in on and some data to look at. The article, the title is going to be different depending on what you're looking at, but the title was Americans' Net Worth Surged by Most in Decades During the Pandemic. A few highlights: households invested more, saw home values jump from 2019 to 2022. Financial strength is thwarting the Fed's effort to slow the economy. That checks out. And then there's a little disclaimer that they mention, since the figures are through 2022, they may not reflect how persistent inflation and high interest rates have increased the financial vulnerability of many families in recent months. So that is a caveat with this data. Is it's not going to show the full impact of inflation in the Fed rate hikes. But the first little chart here is a family median net worth, and its real median net worth among all ages surged 37% to $192,000, 193 ballpark. And you can see the median percent change from 2019 to 2022, which is pretty substantial, particularly among the age group less than 35, um, which which is pretty interesting to me. Um, Statistically, there's another chart that we'll throw up here that shows the real mean, the family average net worth by age, and the real mean rising, 1.8 million among 65 to 74-year-olds. You see the percent change is also pretty drastic among the age group of less than 35, coming in at 101%. We're going to throw up both charts for you guys, but I do want to mention that statistically, I like the median numbers. I think they're a little bit more important. I think they're a little bit more representative of the entire economy. When you start talking about means and net worth, that can get really skewed very quickly, regardless of whatever numbers you're looking at, especially for this kind of thing, just because of wealth gap disparity. All right, and that's why I point out that I care more about the median numbers in this example. That's not always the case, but with this data, I care more about the median. And I think the median chart helps illustrate, why there's been economic resilience, particularly among younger people at lower income levels, right? I think it's a combination of the stimulus checks that we saw. You see some of those stimulus checks, and some of that excess cash being put into the market, being put into homes. You have the increase in the market over that time, the increase in home values over that time. And then when you add in the combination, in my opinion, of the rise of flexible work and the work from home, I think that's helped a lot of people maybe stay in jobs where otherwise they couldn't, or find part-time jobs, that otherwise they wouldn't. And I think when you put all those things together, you look at these charts, it makes sense why the Fed had to hike so so much relative to recent history, and why it's taken a little bit of time for the economy to really uh, feel the extent of those rate hikes. There's the stimulus checks, all those things that I just mentioned. I think that helped the consumer stay strong and is continuing to help the consumer remain strong, which is why it's taken a while for inflation to come down. It's taken a while for the rate hikes to really have their impact. It will take more time, and so I just thought it was kind of a cool chart and made some good points. So,
Yeah, I
any
think it's just
thoughts?
illustrative of, this is if you think about it on simplistic terms, I mean, this is the definition of a supply and demand imbalance. We printed a, you know, what ton of money during
Yeah.
COVID, and with supply chains all messed up, there were not a whole lot of goods going around. So you had more money chasing less goods, and you had, the worst inflation we've seen in a very, very long time.
Yep.
So things in the financial world don't have to be that hard to understand, and this is one of those that it's just people had more money, and if there's more demand for something, people can charge higher prices, and that kind of flowed throughout the entire economy. And that's why you're seeing, things at the grocery store are more expensive now.
Yep.
Going out to dinner is more expensive now. And typically when we see this stuff, and inflation does moderate. I mean, to a certain extent, like supply and demand will influence that pricing. But new houses, for example, because inflation has come down, home builders aren't going to start charging less just because inflation came down. They're just going to let that fall to
Yep.
their bottom line, right? So
Absolutely.
some of this stuff is going to be sticky and not going to go away. But on the other side of that, employees had the most pricing power in terms of asking for raises. switching jobs for higher paying salaries in quite a long time. So, that kind of has helped offset the inflation that we've seen, because
Yeah.
the increase in consumer incomes has gone up substantially too over the past couple of years. So I think that's
Yeah.
part of the reason why we're still kind of okay in terms of consumer spending, because people are making more money than they
Hmm.
had been. So
Absolutely. An excellent point. Yeah.
um last thing here, Nick, the financial planning topic of the week. Not the sexiest topic to talk about, but it was an article in the Wall Street Journal titled "The Big Mistakes People Make in Medicare and How to Avoid Them." And this was by Anna Wild Matthews on October 15th. So just to preface, Medicare can be extremely complicated and extremely confusing. And I think this is why you see some people get in trouble with Medicare, because they just don't know what they don't know. I will say there are experts out there. We know a couple in the Dayton area that if people have questions about Medicare, we can kind of direct them that way, because it's not totally our cup of tea, but it is something that fits into part of people's financial plan, especially in retirement. Obviously, when you're older than 65, and understanding the basics will go a long way with making sure that you're on the right plan and you have the right amount of coverage. So if you're kind of in this window of 62, 63, kind of getting ready to go on Medicare in a year or 2 years, this is something that we want to take a look at. So Anna kind of starts by talking about the Medigap trap. And before I go any further, a Medigap policy is also known as a Medicare supplement insurance. So it's a type of health insurance plan, Nick, that helps cover some of the healthcare costs that, just plain old Medicare Part A and Part B do not pay for. And Medigap policies are offered by private insurance companies and are designed to kind of fill in the gaps or expenses left by Medicare, such as covering deductibles or co-payments or co-insurance. Okay. So Medigap policies don't have network restrictions, so you can see any healthcare provider that accepts Medicare patients, which is a nice thing. But the trick is that patients with health issues may want to move um, to original Medicare, but they can't buy a Medigap policy. So she says that this is where people get stuck, because they get really sick and they can't switch. So Medigap, or again, another term is Medicare supplement insurance, doesn't have the same rules as most health insurance. So for kind of other types of coverage, insurers can't reject you or charge you more based on your medical conditions. But with Medigap, those guarantees are only available at certain times, like open enrollment. So when you apply for a Medigap policy when you're not in open enrollment, you run the risk of insurance companies assessing you based on your current health status, which can jack up premiums if you're not healthy. So Anna says that the best chance to get Medigap coverage is when you first join Medicare after you turn 65. And then you have a 6-month window where you can buy a Medigap policy, and insurers can't turn you down or charge you more based on your health condition. So, really, to kind of wrap this in a bow, I know that was a lot of information, maybe difficult for people to understand, is, if you wait and you forego a Medigap policy, it's a lot harder and a lot more expensive to get that additional coverage for paying for the deductibles and co-payments and co-insurance when you're not in the open enrollment window. So because at that point, insurers can take your medical status into
Yeah, they
account.
can.
So obviously going to cost a little bit more, but I think it's well worth it for most people, because we never know what's going to happen in the future, and it's just good to have that coverage. Next trap that Anna talks about is wrong doctors. So she talks in this article a little bit about Medicare Advantage plan. So this is also known as Medicare Part C, and it's an alternative way to receive your Medicare benefits. But instead of enrolling in original Medicare, which is Medicare Part A and Part B, and purchasing a separate Medicare Part D prescription drug plan, um, you can choose to enroll in a Medicare Advantage plan, which is actually offered by private insurance companies that are approved by Medicare. So a lot of times this can be cheaper for people, and that's why it's so attractive than just basic Medicare. But she says another common trap that kind of gets people who sign up for Medicare Advantage plans is that there's a quote lean menu of doctors and hospitals. So they may also have a hard time getting care if they're traveling outside of their home region. So if you're signing up for a Medicare Advantage plan, you got to make sure that your doctors you want to see are in network, because if you go out of network, then you don't have coverage. Which is really important to a lot of people, right? You know, a lot of people love their doctor and they want to make sure they can continue going to their doctor after they retire and they're on Medicare. But it's important to do that work up front to make sure that if you do go the Medicare Advantage plan route, that you know your doctors are in your network and you're going to be covered.
Another caveat there is making sure that there's enough in-network coverage among specialists that you may have to see. I mean,
Correct.
as you get older, we'll all have to see specialists, and if there's a specialist that's near you, it might not be a network. You have to travel 2 hours or an hour down the road, or you know that's something else to consider.
Yeah, and that kind of plays into the next point is what she says is that Medicare Advantage plans can sometimes delay or block access to care. A recent government investigation found that some beneficiaries were denied services that should have been covered. You might need to get approval from the insurer before you get a surgery or a referral from your primary care doctor to see a specialist. So again, if you do go kind of the cheaper Medicare Advantage route, you just got to make sure that you do your research on those things, because the last thing you want to do is get in a situation where you don't want to go see a specialist because how expensive it's going to be, and it's going to have a
Hmm.
negative impact on the way you live your life in retirement. So
Or you
um
need a surgery and they won't approve it through insurance.
correct. Correct. And the last thing that Anna talks about is drug deficits. So she says your drug coverage can come through a standalone Part D plan, which is the drug prescription plan through Medicare, um, or it could be wrapped into a Medicare Advantage plan. But she says either way, you can use Medicare.gov to see if your prescriptions are included, and this is worth doing every year. So that is kind of nice where you can go and look up online, because obviously prescription drugs are obviously a very large portion of a lot of people's lives, especially as they age. So you also want to make sure that your drugs that you're taking daily, weekly, monthly, yearly are covered under your plan. So there's a lot that it kind of goes on, and a lot of moving pieces when it comes to Medicare. So, highly recommend working with or talking with a specialist in this area. And a lot of times it doesn't cost anything, because these people are compensated by insurance companies. So it makes sense just to reach out to some of these experts, pick their brain, make sure you understand everything before you actually go through the application process.
Yeah, absolutely. Health insurance has always been tricky in,
Yeah.
in our
Yeah.
system. There's a lot. It's very confusing.
So yeah, I don't see that slowing down anytime soon or
No,
getting any less confusing. So
it'll probably get more confusing as time
yeah.
goes on.
So before we get to a listener question, Nick, just want to take a moment and tell listeners, if they are interested in starting their own podcast, you can get your first month of Blueberry podcasting hosting free with the promo code Jessup Wealth, all lowercase with no spaces. Use the hosting estimator on their site to determine the best plan for you. And don't forget, that's Jessup Wealth for your first month free. First listener question we've had in a little while here, Nick. This was from Tim. He says, it might be interesting to discuss at the end of your podcast where the terms bullish and bearish come from. I've heard that it comes from that bulls attack up and bears attack down, but don't know how much of that is true. It's a great question, Tim. And to my knowledge, you are correct. It's because when bulls are fighting, they kind of drive up with their horns. And when bears are fighting, I guess standing on 2 feet, they, claw down with their paws. So that's where you get the term bull market, meaning we're in a strong uptrending market, and bear market where we're in a negative or a downtrending market. Anything to add there, Nick?
No, that's what I'm aware of as well.
Yeah,
I
there's, I
don't
mean,
know
there's a
anything
lot
else.
of
Yeah,
a lot of
yeah,
stories on different,
yeah.
different opinions on how that came about. But just for, simplistic sake, when you hear bull market, usually means good times are here, and when you hear bear market, it means things aren't so good.
Yeah.
So yeah,
Makes
good
sense
question there.
too why the bull, on Wall Street down there, the bull statue, if anyone's ever
Yeah,
been down there.
yeah, exactly. So
Yeah.
before we leave it there, Nick, anything else you want to leave listeners with?
No, yeah, thanks for having me.
Thanks for coming on.
Hope people
As
enjoyed it.
always, it's a pleasure. Thanks for all the information you provided, and thanks everybody for listening to episode 224 of the Independent Advisors podcast. We hope you all have a wonderful rest of the week, and we'll be back next week for episode 225.
Thank you for listening to the Independent Advisors podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.